So we have Dave Foster here. He is the 1031 exchange expert. He is a trades accountant and a qualified intermediary. So he is somebody who can work with you through a 1031 exchange, and he's very active on the Bigger Pockets forums. So if you guys are not already connected to Dave on Bigger Pockets, I suggest connecting with him there. I will be sending out all his contact information in the follow-up email, which I will get out sooner this month because now I'm not moving anymore. So I expect to get out Monday at the latest, and I'll have his information there in case you guys want to follow up, friend him on Bigger Pockets, you know, see his other resources, website, etc. I'll be sending all that out. So with that, Dave, feel free to take it away.
You know, you forgot the most important attribute of mine. I am a certifiable deal junkie. And I got all excited just listening to you guys. It's awesome. I know that I live in a very stodgy, boring world of tax accounting, but I got to tell you, what we're going to talk about tonight is something that translates into how do you maximize deals? And that's where I try to live. I try not to be an accountant. I try to be a deal junkie, or at least an accountant with a marketing heart. So I am right, but I am not technologically savvy. So I am trying to, can you guys see the screen? Oh, that is awesome. Victory number one. So what we're going to talk about in general is very boring, but how you apply it is where it gets really exciting, because it's going to make all the difference in your portfolio performance and how you end up the game. And that's really what it's all about. There's an old adage in the real estate industry, and I'll bet you guys can repeat this. You make money in real estate when you, who said buy it? That's exactly right. That's the old adage, right? Because you buy low, you sell high. You make all your money when you buy the real estate because you bought it right. But I'm here to tell you, in 1996, I discovered through the School of Hard Knocks that there's another half to that. My wife and I were wanting to get out of two pretty high-profile corporate jobs, and we had a goal of moving onto a sailboat and raising our children. And like millions of other people, we said, gosh, wouldn't real estate be a great tool? So I bought a fix and flip, and yes, I bought it right. A piece of downtown Denver in Sloan's Lake for $100,000. And then I fixed it and flipped it. And I thought, that's it. I made money when I bought it, until I went to Turbo Andy, my accountant. And he said, boy, did you really mess up. You know what your tax bill is? And that's when I learned not only that I had a silent partner whose name was Uncle Sam, but he was going to make more money than me on the deal. And that's when I discovered the second most important phrase in real estate. You may make your money with how you buy it, but it's how you sell it that lets you keep your money. And that's where the 1031 exchange is going to come into tonight. But let me give you a little bit of bonus material. You'll start to understand how these things interplay. There's actually two parts of the tax code that talk about how real estate is taxed. The first one is Section 121. And you all may know this or not, but it deals with your primary residence. If you have lived in a house or a property that you own for 2 out of the 5 years prior to selling it, then as a single individual, you get to take the first $250,000 of profit tax-free. If you're married, you get to double that, the first $500,000 in profit tax-free, just for buying a house and moving into it and living in it for 2 years. I don't know about you, but that's kind of awesome. Because like Adrienne said, everybody's got to live somewhere. Why don't I live somewhere where I can take the profits from the sale tax-free? Now, the kicker to this is that you can do this once every 2 years. So I am married to the amazing Vicki Foster, who is the most patient soul in the world. And we've been able to do this 7 times. 7 times because she was willing to move. You know what her only requirement is? If we're going to do this, Dave, fix up the house before we live in it for 2 years. Don't wait until right before we sell it to do the rental. Okay, fair enough. But what NAR tells us, the National Association of Realtors, is that typically people live in their houses between 5 to 8 years, which means over the course of your investing and life career, you're going to have maybe 7, 8, 9, or 10 opportunities to take profit tax-free just by living in the property. So that by itself hopefully stirs up a whole lot of strategic thinking in your part. But this is dealing with your primary residence. Now, the other part of the code where we're going to spend the most amount of time tonight is on Section 1031, which deals with all the other types of real estate that you hold for investment. And what Section 1031 says is that when you sell investment real estate, you get to defer indefinitely the payment of the tax and any depreciation recapture that would normally be due on the sale. So Section 121, primary residence, tax-free every 2 years. Section 1031, investment property, indefinite deferral of the payment of the tax. And you can do them as often as it qualifies. So no matter what kind of real estate you own, potentially there's a way to not have to pay the tax. And what's so key about that is that talks about the second half, how we keep the money in our pockets instead of making great money and then paying it out in tax. Now, there are 6 basic requirements to the 1031 exchange that all have to be met. And we're going to go through them real quickly. The property has to be held for investment. There's a couple timing issues that have to be dealt with. There is the requirement that you must use a qualified intermediary to handle the transaction. There's some requirements about titling, how that has to go. And then lastly, there's requirements on how the cash has to be reinvested. Now, we're only going to be able to touch on these tonight. So hopefully you come away with an appreciation and some information and some context so that we can flesh a bunch of these out. But let's real quickly go to criteria number 1. The property must be held for investment. The use of the property is what's key. And it's property that's held for trade, meaning I'm a restaurateur and I own a building that my restaurant is in. That's my trade. Not that I'm buying property to trade it for this property or that property. We're going to find in just a minute that that kind of stuff actually may not qualify. But property that I use if I'm a shoe manufacturer and I have a shoe company, it's property that we own for our business. Now that's where rental landlords live, isn't it? I have a business where I buy property to rent it out and make the income. So I'm using the property in business. A farmer that owns agricultural property, he's using it in his trade. Maybe he sharecrops it out. So he's not doing the actual farming, but he's holding it to make money off the rents of the land. That's holding it for business. Same thing would be true of a real estate broker who has a storefront. He's owning it for his trade. He may also be renting space to all of his agents. The third way that we own investment property is to own it for investment. Okay, duh, Dave, what does that mean? I've got investment property I own for investment. Well, because the IRS never likes to use one word when one paragraph will fit, here's what they call investment. You hold property for investment when you purchase it with the intent of holding it to garner the incremental increase of value as a factor over time. Give me one word that is. How about appreciation? Thank you. I buy property because, not because it's a bargain today and I can sell it tomorrow, but more because no matter what it is today, it's a good buy and it's going to increase in value, the key being over time. So I buy property to use my trade. I buy property to use for business. I buy property because it's going to appreciate. That's what the IRS means by investment property. Any property that's held to produce that income or held to make that appreciation can be exchanged for any other type. So you may have heard the words like kind used. That doesn't mean purple duplex for purple duplex. It means any kind of investment property for any other kind of investment property. Now, if you notice up at the top, there's going to be some questions that you can put the answer to in the chat section. If you're the first person to answer it, we're going to give you a shout out and you get a cup of coffee. Property that qualifies as any property held real estate. It's got to be real estate. But the states define what real estate is. For instance, I'm doing an exchange right now for a gentleman in North Carolina. You know what he's selling? A boat slip. How can a boat slip be real estate? Because it was condoed out and he receives a tax bill from the county tax collector and property appraiser every year. He now owns a piece of real estate that's nothing more than a hole in the water. Because North Carolina considers that to be real estate, voila, it's real estate for Section 1031. Trailer homes and RVs, when they are attached to the land and they're sold along with the land, those are real estate. Oil and natural gas and mineral rights are considered to be real estate, things that you wouldn't necessarily think of. But the category is really broad. So you can sell, actually, you can, well, we'll just go out. I'll come back to that in a minute. So hold period. This is one of a key. In general terms, remember we said it is property that you held with the intent of using to produce income. So in general, there's a thought that the longer you hold it, the better. But guess what? There is no statutory holding period. So you may have heard 12 months. Why 12 months? Well, 12 months turns property from ordinary income into a capital gain, which is nice. And who did I hear talking about that? Yeah, there you are. That brought tears to my eyes, gotta tell you. But that's exactly right. So if you have a longer term horizon in mind, that property is going to qualify, but not specifically because of the time, more because of what your intent was. So if your intent is to hold it for productive use, it doesn't matter how long you've held it, but you're going to have to be able to demonstrate your intent. One of my favorite stories of all time actually comes from where you're talking about earlier, Adrienne, that area up around Sevierville and Pigeon Forge. I did an exchange earlier this year for a client who owned the property for 30 days. Now, wait a minute. How could you do that? If I bought a property and sold it after 30 days, doesn't that make me a fixer flipper? Didn't I buy that with the intent of reselling it so I wouldn't be able to do the 1031? Well, I asked him about that. He said, but Dave, I meant to hold it. As a matter of fact, when I bought the property, there was a clause in the settlement statement, the contract, that I had to honor the lease of the longtime tenant that lived there. I said, well, yeah, that's pretty good evidence of your intent. But Jose, okay, so tell me, why are you selling it then? What's the deal? He said, well, it had to do with the bear. What? The bear that took up residence by the trash cans for the property. The tenant moved out because she didn't feel comfortable sharing her house with a bear. I said, I can't guarantee anything with the IRS, but dang, if they're not going to let it pass because a bear moved onto the property, I don't know what would qualify. So 2 takeaways from that. It's not the hold period. It's the intent and how you demonstrate it. And secondly, Adrienne, you better put a wildlife clause into all your contracts if you go up there, okay? Like kind property means any kind of real estate in the U.S. for any other property in the U.S. or a couple U.S. territories of Guam, the U.S. Virgin Islands. It's foreign property for foreign property. But what you can't do is sell in Ohio and buy in Belize. Or you can't sell in the Dominican Republic and buy in Florida. U.S. for U.S., foreign for foreign. One thing that a lot of people are asking about now is Puerto Rico, because Puerto Rico is U.S. territory. Unfortunately, there's something about how the treaty was made. Puerto Rico does not count. So I'm just laying it out there. But if you like the U.S. Virgin Islands, you can sell in Virginia and go buy in St. John's. And that's a fine 1031 exchange. Rental property is always going to be an investment. And why do we say that? Because it exists to rent for income. But bare land also is always an investment. Why? The reason I want to distinguish these two is because bare land many times will not make revenue. And revenue generation is not a requirement for property to qualify for 1031 treatment. What's the requirement? That your intent be to hold it for productive use in business, trade, or for investment. Now, one of the mantras in our industry used to be a year and a day, a year and a day, a year and a day. You hold it for a year and a day, you'll be just fine. And for the most part, that's something people pretty much believe in. But just like our guy with the bear, it may not have to be a year if you can demonstrate your intent. Or just like the guy that held property in a subdivision for 12 years and that did the exchange and it was disallowed by the service. It may not be the length of time that matters. Why was it disallowed? Because the idiot forgot to take the listing off the MLS for 12 years. It was up for sale for 12 years. So what was his intent? For 12 years, his intent was to sell, not to hold. And I think you start to see how the quirky thing is. Here's Bill and Jane. By the way, Vicki, who won our coffee challenge?
Christina.
Christina! Woo, way to go. Did she get it right?
Fix and flips do not.
Fix and flips do not qualify. Why? Because your intent is primarily to resell. Awesome job. Bill and Jane have a duplex. They want to sell it. And absolutely, it's time to go buy a condo at Myrtle Beach. Yes, I heard those magic words. And you're going to rent it out to others and use it some themselves. Does that qualify? Wave your hands if you think yes. Absolutely, because there's no restriction on some personal use. So I don't know, buying the condo at Myrtle Beach, putting it in a vacation rental program when it's not booked, use it yourself. Not a bad plan, is it? Here's the second requirement. From the day that you close the sale of your old property, you have 45 days to identify potential replacements. Now that's 45 calendar days, and day one is the day of closing. So from that day, you only have 45 days. At the end of day 45, that list is set in stone and cannot be changed. During the 45-day period, you've got to either complete your purchase or produce a written list of your replacement properties. It's got to be in writing. It's got to be specific identification. If you name 3 or fewer properties on your list, then it doesn't matter how much they're worth. But if you name 4 or more properties, then we get into some rules about how much their valuation can be. And we just don't have enough time to flesh that out today. Here's your key takeaway. There's no individual exceptions, and there's no individual extensions. That's key. An extension like something for COVID did happen, and they're nice things to hope for, but don't plan on it. So Bill and Jane want to sell a rental for $100,000. They want to name 2 or 3 replacements for $10 million each. Is that okay? Let's put a coffee challenge up there and see who thinks it is. But I'm not going to wait. I'm going to wait 5 seconds more. Free coffee. The answer is yes, that is okay.
Eric said yes.
Eric, way to go. Because you're only naming 3 or fewer. Bill and Jane want to sell a property for $100,000. They want to identify 4 condos for $75,000. Is that okay? The answer is maybe. Because technically, if you name 4 or more, it can't be more than 200% of what you sold. And they sold for $100,000. So 200% of that would be $200,000. The 4 condos they're naming total $300,000. So they're breaking the 200% rule. But the exception is if they closed on all 4 of them, they could still make their exchange work. All I want to leave you with on this, because we're running short on time, is that the 45-day is the most critical rule. It'll sneak up on you. It's pressure that you don't need, but you get anyways. And if you don't need it, you lose it. And that's the place where the IRS has chosen to add even more restrictions on you. Because while they don't care how many properties you actually purchase, you can sell 1 and buy 2, sell 1 or buy 5. What they care about is how you identify them. And that's where the gotcha is. So when you're working with what we talk about in a minute, the QI, 45 days, you want to really be in touch with them as you're going forward on that. Simultaneous to the 45 days, concurrent with, you have 180 days from the date of the closing of your sale to take title to your replacement properties. And by default, that property or properties that you purchase have to be one of the properties on your 45-day list. If you close before day 45, then by default, that becomes your list. But after day 45, those are the only properties you can close on. And you have to do that. If you can't, then your entire 1031 goes out the window. Again, no individual exceptions, no individual extensions. But here's another gotcha. And it demonstrates something. Because there's no penalty for starting a 1031 exchange and not completing it, you actually don't have 180 days. You have 180 days or the date of your next tax filing. And the reason for that is that if the date of your next tax filing comes, you either have to report a completed 1031 or you have to report nothing, a sale of real estate. So that's why sometimes your 180 days can get truncated. But there's an easy answer, and it's in the heading of that slide. Simply file an extension, and you'll always get your full 180 days. Okay, blazing right along. You must use the services of a qualified intermediary. The IRS requires it. It is an unrelated third party to all the rest of the extension. Dude, Gus, you're making me dizzy. Whoa, now they're dead. Is there a home break-in going on? I'm just kidding you. I'm giving you grief. The qualified intermediary is required by the IRS, has to be an unrelated third party. We don't do anything in the process except for the 1031 exchange. So you still use all of your regular professionals, but we enfold into that process. Here's the key, gang. The QI has to be involved at or prior to the closing of the sale. If the QI is not involved before your sale closes, no exchange. So that's what we do. We're the qualified intermediary. All we do, process the 1031 part of the transaction. And I think as you're starting to see, someone who's going to help you wade through all this swamp of rules is going to be pretty key to your success. Title requirements, or as I call it, the taxpayer requirement, essentially says that however you hold title to the old property is how you need to take title to the new property. Or another way of saying that, whoever is the taxpayer for the old property, because remember, the only way we communicate with the IRS is through our tax filings. So however that property, whatever tax return that property is reported on, the old property, is the tax return that the new property has to be reported on. Reinvestment requirements. Does anybody have teenagers?
Yeah.
Nobody? Let me tell you how blessed you are. At 14, they go through this phase called pyromania. And if you've got acetylene torches, cigarette lighters, or anything in your house, they'll find them. I am right now smelling the lovely smell of either a chimenea fire or the other half of our house. If you see me run away in a moment, you'll know which it is. Here's the last requirement that has to be met in order for you to do a successful 1031 exchange. And this involves the reinvestment requirements. And again, this guy's a little quirky. So if you want to defer all tax and depreciation recapture, you need to do two things. First, you need to reinvest in the new properties all of the cash proceeds. Secondly, you must purchase a property or properties that are at least equal to, excuse me, or greater in value than what was sold. Now, another way, a quick down and dirty way of figuring this is to go through your closing, and at the end of the closing, take the amount of cash that goes into your exchange account. Add to that the amount of mortgage that was paid off. That's going to equal your reinvestment goal. Pretty handy, huh? Now, for those of you who are accounting or spreadsheet nerds or realtors used to dealing with settlement statements, it's also the net sales price of the old property. Now, think about that. The net sales price of the old property is what? The contract price minus all closing costs and commissions, but before the mortgage is paid off. So if you take your contract price, subtract your closing costs and commissions, that's the net sales price of your old property. That's how much you have to purchase in order to defer all tax. Then you also have to use all of your net proceeds, because from the net sales price, the mortgage is paid off and the rest of the money goes into your exchange account. So whether you like to think that way or whether you like to think of it as it's the cash in my account plus the mortgage that was paid off, it's going to be the same number. But that's your reinvestment target. Now, everybody always wants to say, but Dave. Actually, but Dave is a very common start to questions in my line of work. But Dave, I put $20,000 down on this property. That's my original capital. I don't have to pay tax on that, do I? The answer is absolutely not. You don't. That will never be taxable. But here's the problem. When you do a 1031 exchange, the IRS is telling you that they will leave their tax in the deal. You must leave your profit in the deal. Okay, so, but Dave, can't I take out my original capital? The IRS interprets things differently when you're doing a 1031 exchange. If you purchase less than what you sell, or if you take cash out, you can do that, but the IRS says that the difference between your sales price and purchase price, or the amount of cash you took out, is taking profit. But Dave, I'm taking out my original capital, not the profit. Hey, I get it. It's the same dollars. But what you interpret as taking your original capital, the IRS says, nope, you're taking profit first. Does that make sense? If your answer is no, I agree with you. But it's how they choose to interpret it. And guess what? When it comes to arguments like that, the team that has nuclear weapons and a standing army always wins. So if you purchase at least as much as you sell, and if you use all the cash, you'll defer all tax. Take any cash out or purchase less than you sell, pay tax on the difference, but shelter the rest of the gain that goes in. So here's the basics. By the way, look at this coffee challenge as we start to review the basics. And Vicki, tell me when someone answers it. So the first basic requirement is the property must be held for what? It's not my primary residence because that's section 121. It's property that's held for investment. Any kind of property that's held for investment. From the date of the closing of my sale, how many days do I have to identify potential replacements? 45. What's the entire length of my exchange period? 180 days. Who is Dave? A qualified what? Intermediary. The critters that do the 1031 exchange for you. And it's at this point, Vicki, has anybody answered yet?
No one has answered yet.
Guys,
So-
come on.
Okay, Eric and Christina can answer again if they know the right
Eric
answer.
and Christina answer again. We'll give you 2 coffees. Well, I'm here to tell you that my job as a qualified intermediary is to document the 1031 on your closing statements for your sale. So let me ask you, if you call me a week after your sale, do you think I can get the sale, the settlement documents changed? No way, Jose. So can I help you complete an exchange? Part A, yes, because I'm a qualified intermediary. Can I do it a week after you close your sale? No. The intermediary has to be in place prior to the closing of the sale. Tell me we gave away a coffee, Vic.
Christina gets more coffee and Gus answered too. So Gus gets
All right, Gus, you get coffee too. Christina, I'm apologizing to your family on my behalf tonight because you're not going to sleep. I get it. And lastly, what are the requirements that the taxpayer be the same? It's what we call the title requirements. And finally, if you want to defer all tax, you must purchase equal or up. There's a minimum, but not a maximum. And you know what? That's one of the coolest things about 1031 that people will do is they will use their sale as a down payment on something bigger. And it can be really awesome. So let me tease you with a few of the uses of these things, and then we'll go into a Q&A section. Sound good? So consolidation exchanges. It's the value, not the number of properties that matter. So I could take several properties and start exchanges on all of them and use them to purchase one much larger property. What's the unicorn in today's real estate market? The underpriced value-add multifamily. Everybody wants it. Well, those are pretty pricey. But if you sold 4 single-family rentals for $100,000 each, you could use those as a down payment on a large multifamily. The key is they all have to meet the timing requirements for all of them. So in that instance, the timelines of your first sale are where they're going to be critical. Diversification exchanges, just the exact opposite. I sell a property. So this is what I've done over my life. I love to tinker, and I've got ADHD, and somewhere inside of me, there's an architect who is way too lazy to go to school that long. So what I would do is I would buy properties and I would fix them up. And here's where I had the choice of becoming a fixer flipper, like I did that first time, and paying a lot of tax, or renting the property out. And then a year later or so down the road, selling that property and doing a 1031 exchange. So I buy it for 100, I put 20 into it. I sell it for 300. I've got a $180,000 gain that's coming in. What do? Do I go buy one more $300,000 property? Heavens no. I go buy 3 more $100,000 properties. Why do I do that? Well, I do that for a couple of reasons. Number one, because I'm using leverage to my benefit, because I'm going to put leverage, it's modest leverage, but I'm going to put leverage on each one of those. Secondly, and more importantly though, Dave understands $100,000 renos. It's my sweet spot, if that's who you are or whoever. I know what kind of flooring to put in. I know what kind of countertops. I know who my market's going to be. So why would I want to sell that and go buy a $600,000 luxury fix-up? If I don't understand that type of market, I'm better off going and buying $350,000 or whatever single-family homes and fixing them up and putting renters in them and then selling them. What am I going to buy with them? 3 more of each. And all of a sudden, properties in your portfolio start to look like coat hangers in your closet. They just multiply. And one day you call me up and you say, Dave, we've deferred a whole ton of tax, but I'm tired and I don't understand why. Well, I don't know. The phone keeps interrupting us with the plumber calling you about one, the tenant calling you about another, your management company calling you about a third. You're tired because you got a bunch of these properties. So what are you going to do to simplify things? Start to do consolidation exchanges, sell several, purchase fewer. Do you kind of see how over the course of a market, you can use 1031s to expand and then contract? Retirement needs. How many of y'all live above the Mason-Dixon line, don't you? Do you know what the Mason-Dixon line has north of it that isn't south of it, besides as many Trump flags? You guys all have these things in your garages called snow shovels. We don't have those here in St. Petersburg, Florida. So if you've got a rental in Northern Virginia and you're thinking, maybe I want to retire and I'd love to manage a property where I didn't have to shovel the driveway, you could sell your rental property, use the proceeds in a 1031 exchange, and buy a vacation rental before you end up moving down, so that your rental property is waiting for you with income coming in, but without snow. And it's still available to you also, if you're doing it as a short-term rental, for you to come down and visit many times before you retire. Wow, that's kind of awesome, isn't it? Here's the way another family did it. Sell the family farm. Now, the family farm is made up of 2 different properties. It's made up of your primary residence. Remember how the primary residence sale is tax-free? And then the farm is also made up of the agricultural land. So this family sold the family farm. They took the allocation to their primary residence tax-free. They did a 1031 on the rest. So did they pay any tax? No. Part of it was tax-free. The rest of it was tax-deferred. They went to their children and said, we need income for a while, but would you mind managing a property that you pick out until we die. We'll split the income with you, but we'll still get income. And when we die, you get the property. Now, their children were very happy to do that. So we bought 3 properties for the 3 kids, but they were in the name of Grandpa and Grandma because that honored the 1031, right? So they walked away from this sale with tax-free money in their pockets from the primary residence allocation. They indefinitely deferred the tax on the rest of the properties. They had motivated managers because their children were doing it for them. And here's a key that I haven't talked about yet. We have a mantra in the industry that we call the 4 Ds. If you're going to be the best 1031 investor you can be, you need to know these. And the 4 Ds are defer, 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 and then die. Because as long as you own the property you 1031 into, you'll never pay the tax on it. That includes if you buy a vacation rental and use it for personal use. That includes if you buy a vacation rental and a couple of years down the road decide to heck with the renters, I'm moving into that. The sale does not create a taxable event. As long as you own it, you'll never pay the tax. As long as any time you sell your property and do another 1031 exchange, you'll never pay the tax. And as of right now, when you die, your children get the property at what is called a step up in basis. So they get the property and the tax goes away. So it is truly tax-free for your heirs. So repeat after me. What are the 4 Ds? Defer, 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 and then die. Grandma and Grandpa had children that knew what they were going to get. So not only did they make more money off of those properties than they ever did farming, which is kind of sad but true. But do you know what Grandma figured out early on? Every trip to go see the grandkids was a tax write-off to go see their investment properties. How's retirement get any better than that? That's an example of diversification exchange. Remember, you can use the 1031 to go anywhere in the country at any time, into any sector, into any amount. And if you want to move your portfolio forward, there's always going to be a way to do it without paying tax on it. So property that's investment property, 45, 180 days, the qualified intermediary requirement, Tyler requirements, and the reinvesting equal or up. If you can get a handle on those 6, that will take you a long, long ways. We did just about 36 minutes exactly. I'm going to take a deep breath. Let's have some questions. By the way, you just got in mini format what we take 3 hours to give to realtors in our CE classes. So congratulations. Either that or that just means the realtors are real slow. Of course, I'm probably talking to a bunch of realtors. I know, Adrienne, you just passed your license. What am I saying? Just kidding. It's a lot of stuff. Any questions?
I have a question.
Okay, go for it.
So, with the I don't want to talk about politics, but with the changing of the House and the presidency and stuff, I saw a lot of changes in the 1031 exchange, or maybe I'm not sure if any changes are going to happen. But do you have some insight on the 2021 1031 exchange policies?
Yeah. Absolutely. By the way, Eric, I have no problem talking politics. And here's why. Because as Gideon Tucker once said, no person's liberty or property or possessions are safe as long as Congress is in session. He never said whether it was a blue or a red Congress, because they're all the same. Your property is always at risk if Congress is in session. You know how I know that? Because interestingly enough, the single change to Section 1031 in the last 25 years was done by none other than well, depending on who you are, maybe our outgoing president. President Trump, former or not, restricted 1031 from qualifying for personal property. We used to be able to exchange jet aircrafts, heavy equipment, herds of cattle, and we now can only do it for real estate. That was a Republican that did that. So, doesn't matter to me what Congress is in session. I don't trust any of them. So that's my political statement, Eric. But you're absolutely right. A couple things that incoming President Biden or President-elect, maybe depending on who you are, whatever, a couple things that he's talked about doing. Number one, doing away with the 1031 exchange. Now, I'm not worried about it yet. Why? Because honestly, guys, don't you think that the best thing right now for all of us is gridlock? Let's get a Democrat House of Representatives. Let's get a Republican Senate. Let's get a president who is, I don't care, so that they're all just working against each other. Nothing ever gets done. So I'm not too worried yet. But even if he wanted to, every president since I have been doing 1031 exchanges for 21 years now has talked about doing away with them. And what they typically find is that there is so much activity and commerce generated through real estate sales and allowing people who would not have the tax to pay, would not have the cash to pay the tax if there was no step up in basis or 1031, that as a stimulus to the economy, they almost always come down on the side of, we need to keep this thing going. So I wouldn't worry about 1031 specifically yet, but they are going to be talking about it and it'll be addressed. The one that concerns me more from my long-term investing point of view is the step up in basis. Remember, that's the fourth D. I don't know what I'll have clever to say if all I can call it is defer, 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 and then get screwed out of your kid's inheritance. I don't know how I put that in there. If they do away with the step up in basis, then your heirs will get stuck with that tax. And if you have done 1031 exchanges over the course of your lifetime, that could easily be $400,000 to $500,000 in tax. And you're wanting to pass on the properties to your children, but they will have to sell the property just to pay the tax. So that one is a concern. But believe me, there's a lot of people in Congress. I don't know how they do this on their meager salaries, but there's a lot of people in Congress that seem to have really nice vacation rental properties in Nantucket and the east coast of Florida. I'm pretty sure that when they see the impact of what it's going to do to their children, they'll be wise up. We'll see. Does that help?
That was great. Thank you. Thank you. That's a question I've had for about like 8 months now.
Oh, I know.
So
yeah, it comes up
thanks
every
for the
time.
insight. Yeah.
Gridlock. What do we want? Gridlock. When do we want it? Now. Anybody else?
Yeah, Dave, just a clarifying question. The list of properties that you have to identify, is that given to the qualified intermediary?
Yes. The reason why, though, is not because that's required, but because as the QI, we have a fiduciary responsibility to the process. So we have to see it ourselves before we'll release money to you or for your purchases. But the way the actual rule reads is that that list is something that's written between parties to the transaction. So you could simply go into contract for a property during the 45 days and forget to tell me. Now, and then go on vacation to Italy. Round about day 43, I'm going to be trying to find you. Help. Josh, you're going to get email notices from us saying your 45 days is expiring and you're going to be off the grid and drunk in Tuscany. So what do? You come back and you say, and I tell you, Josh, tell us where you want your proceeds sent because your exchange is done. You say, but Dave, I was under contract. That's fine as long as the dates are prior to day 45. So you can see why for my heart condition, it's really important that you turn it into us. But technically speaking, it just needs to be in writing somewhere where we can forward it.
So outside of the tax return, are there any other documents that need to be filed with the IRS in order for the 1031 exchange to take place?
Yes. As part of the closings, there actually has to be an exchange agreement which shows that you were employing a qualified intermediary. There has to be, you guys will love this because this is truth stranger than fiction. There has to be an assignment of your rights. You literally have to assign your rights to sell the property to us. And when you buy the new property, you have to assign your rights to buy the property to us. Now, we never take title. We have it directly deeded from you to the buyer and from the seller to you. But at the end of the day, you have to be able to answer this question. Did you sell a piece of property? The answer is no. Did you buy a piece of property? No. What did you do? You exchanged properties with your QI. And honestly, that is what the Second District Court of Appeals called in a ruling the legal fiction of the 1031 exchange. That hurts me to the core on so many levels, but it tells me what they really feel about me. I'm legal. They have to let us do these, but they certainly don't have to like me. They wish I was fiction. That's how the assignment. And then in addition to that, Josh, there's one other piece, and that is that a notice of that assignment has to go to all parties to the transaction. Now, if you're ever audited, you'd better be able to show bank statements of where the money went, wiring things to show that you did not touch the money. But that's all separate and secondary. When your accountant files your tax return, the only thing that they will do is take all of your 1031 documents and closing statements, and they will prepare the form 8824. You know, I realize I just drew that with my finger, and that's probably backwards. So if you can actually read that, I'm impressed. The 8824, and that's what reports your exchange on your tax return. Anyone else? By the way, you want another truth stranger than fiction? Do you know what qualifies an intermediary, a qualified intermediary to do your exchanges? Anybody got a guess? What makes me qualified? No guesses? I got y'all scared, don't I? Adrienne! You know, I feel like Rocky. Adrienne!
I was wondering what it took to be a qualified intermediary.
Well, how many hours of class did it take for you to get your license in Tennessee?
I already had, I'd say roughly 60 if I wasn't already a realtor.
60 hours, oh my gosh. And then isn't there also post-licensing and every 2 years, yada, yada, yada? Do you know what literally makes me qualified? This is in the statute. I am qualified to be your intermediary. If I am not, disqualified. It says it. And the only thing that technically disqualifies me is if we have a business or family relationship. So if I'm your barber, I can't be your 1031 accommodator. But if I happen to sell used tires down the street, I could be your QI, as long as I don't sell tires to you. Crazy, isn't it? I cannot make this stuff up. Okay, that's the fear factor. What's the reality? This is such a boring, detailed, nasty with requirement statute that generally the only people who go into it are attorneys and accountants whose only other occupation will be watching kitty videos. This is what we do and all we do it. So ask questions to make sure they've been in business a while, because honestly, they could just run the mortuary down the road from you. So make sure that they've got demonstrated experience and they know what they're doing. You got to ask, because the bar to become a QI is really just about as high as what it takes to use WordPress to start a website.
Good to know.
Anybody else?
All right. Well, I will share Dave's information so that if people have more questions after the fact, or when you are ready, to do your own 1031 exchanges. I know, Christina, you're buying and selling like crazy there, so maybe you will be with that place in Winchester or something like that. I'll share Dave's information so everybody can reach out to him. So thank you so much, Dave, for sharing all your wisdom with us today.
My pleasure. It was so much fun being with you guys. I'm leaving you with that quote from Justice Lerner Hand on the screen there. That was a Supreme Court justice when the tax code was first put into place. And if you look at that back then, the sentiment was pay what you're supposed to and not a penny more. I think the scales have tipped, but it is still your right to try and avoid tax by any legal means necessary. And I found in my life that 1031's been awesome. Love to help you out.